Hey everybody, it's Judy with eXp Realty, and I don't know if you are like me, but recently I had to go through all of my homeowner's insurance policy. One, prices just went up, and two, I have a new driver. So I felt like, oh my gosh, I just want to mitigate my expenses, but then I realized, hey, what if something happens? Am I fully covered to the extent that I want to be? So it really got me thinking. And so I just wanted to focus on homeownership and homeowners insurance and what's best for you. Not just what's cheapest for you, but what's best for you. So I brought in a couple experts. One is Alan.
Yep. Alan Johnson with American Family Insurance.
And Broch Lassig with Cross Country Mortgage. And the three of us are just going to have a conversation candidly about homeownership and homeowners insurance.
Absolutely.
Cool.
Okay.
Excited.
Yeah.
So I had a couple questions. The main talking points is I didn't do anything and homeowner insurance went up basically because of what's happening as a whole nation. And I have some questions for you. I think you can explain the whole basis behind that because all of us are affected by something that's happening to a small percentage of the country.
Absolutely, we are. So, and remember to view it, to kick it off, like insurance is in the law of large numbers. It doesn't matter what happens to you personally or your home. You never want to have insurance where you're only affected by what you do to your insurance, because then it would be astronomically high and nobody would be able to afford insurance, because if you made one wrong turn, then your insurance would be unaffordable. So being in the law of large numbers is definitely the way we want to go. And I'll explain that a little bit further as we go.
Okay, awesome. Any thoughts for you, Broch? You feel the same way I do on that
Oh, yeah.
one? Like, why
Yeah.
is this happening to
It's
me?
a nightmare.
But
I just call Alan.
I'm his insurance
And
guy,
complain.
so
Yeah.
he doesn't have
Yeah.
nightmares.
yeah, no nightmares for you. Okay. What's causing the premiums to rise?
So what you're asking, Judy, is
Right.
about inflation. So inflation, if you look on the inflation index, which these guys tease me and they send it to me like every week on the inflation index.
He's the reason rates are high.
Listen, it's not me. It's the insurance industry as a holistic part of it. So the insurance industry has taken big hikes. So as you see your tariffs coming through, as you see these wildfires happening in California, as you see these tornadoes happening across the Midwest, as you see these hurricanes happening in Florida, remember, all that is passed to you. And it doesn't matter if your insurance company is actually in that state, within Florida, within California, within bordering states like Texas. It doesn't matter if your insurance company is there or not, because they have what's called reinsurance companies. Every insurance company has reinsurance, okay? And those companies are always involved. So any one of these hits, whether your company is in that state or not, is taking some kind of financial loss. And you got to remember, as inflation grows, as the prices of to build homes gets higher, as the prices of cars gets more expensive to build. I mean, a headlight nowadays costs $1,500 for a new car. That is absolutely astronomical. So a new bumper runs around $2,000 to $4,000, depending on what car. If you're driving Brock's car, it's probably around $8,000. So, the prices keep getting higher and higher. So as these prices, the insurance companies are having to pay out more, which is driving these prices up. So again, doesn't matter where you're at or where it happens, it's going to affect you some way, somehow.
We talked about like it's hitting other regions, but like for some homeowners, the fires in California. Well, we have similar situation in Immigration Canyon with luxury homes and everything. So like I've heard of people are having a hard time actually insuring their properties depending on what's around those homes. So like if you live in an area that's naturally wooded, like Park City, Heber City, Immigration Canyon, you basically live in a similar environment as what we saw in California.
100%.
How are those homeowners affected with their homeowners insurance?
Well, those homeowners are hugely affected in the part where it's going to be hard for them to find insurance at all. So every home has its own fire rating score. It doesn't matter whether you live in South Jordan, you live in the Hills in Park City. It doesn't matter where you live. Every single home has a fire rating score attached to it. And to put that in simplistically, it goes from 0 to 100, 0 being the best score, 100 being the worst score. Most companies won't write right now. They won't after the California fires. They were writing up to about an 88 wildfire risk score. Now we can write about a 63. 63 fire. So as these wildfires are happening and they're getting more prevalent in the states of Utah or wherever it may be, they're starting to cut back on what they're going to write and what they're not. I have a buddy that writes insurance up in Park City, and it's almost impossible to write anything. You're talking about $10 to $20 million homes up there, and it's getting to the point where you can't find anybody but one or two people, which is kind of creating a monopoly. So you're going to pay through the nose for that. You got people paying anywhere upwards of $21,000 to $36,000 a year just for homeowners insurance. So as these fires keep happening, as they become more and more relevant to our states, you're going to find insurance companies dropping that location or that area where they're not able to write policies. So there's these other companies that are stepping in and almost creating almost a monopoly on this. So meaning if you only have one or two companies, they're going to charge you through that the nose for insurance because they know they can get that premium from you. And plus it's a huge risk for them. If you got a $10 million, $20 million home that burns down, you're probably never going to recoup that.
Right.
So I've got a question, Alan.
Yes.
You first explained insurance essentially as a socialized program to help costs remain affordable.
Yes.
But you're saying they're not remaining affordable now, and now not even accessible. So to me, and I'm curious genuinely, and probably other people, it seems to me like, okay, wildfires are happening. Clearly the socialized funding approach to insurance and reinsurance and probably the financial aspects of how they invested that money, so on and so forth, isn't working. So is there a complete reform on insurance altogether? Because if you can't insure a property in Harriman because it's on the hillside, that's a problem because us lenders, you can't get a loan now. So something's going to have to change.
Well, it's exactly. So again, to your point, it comes back to your DTI issue. So if someone's got a $21,000 premium and that's the only monopoly they can go after, then absolutely it's becoming a problem. Then it's not law of large numbers. It's becoming smaller and smaller group that associates with actually writing these policies. Like I said, 2 to 3 companies being able to write these, like I said, it creates what we call a monopoly.
But if they can't get insurance,
if they can't get insurance,
they can't get a loan at all.
But there are
they can't buy the house.
Right,
but there are states that are actually stepping in and funding insurance, but it's astronomically expensive. So like in California, I don't know, you're probably going to end up seeing it being state funded. So, and they're going to pay through the nose for any insurance. They already have a mansion tax over there. And then they also have, a $10 million home in a high fire risk score in the state of California. There's only 2 companies that I know that will write it. And you're talking almost $250,000 in premium a year to insure that home.
But that's where we're going to be in the future too.
Yes. Again, it depends on the state. Like I said, law of large numbers, but now it's starting to dwindle down. That law of large numbers becomes inadequate now because
this law is no longer a law because if now these insurance companies don't cover California, well, that takes a massive amount of insurance out of the whole nation. There's so many people and houses and things there. So now the quote unquote law of large numbers is no longer, it's law of much smaller numbers than it was before because now they won't cover California. So that's what I'm saying. It almost seems like this whole philosophy of the way the insurance world works today, as we know it today, is dismantling before our eyes.
It is dismantling. It is dismantling because everything is getting so expensive. So, and there's no way for smaller insurance companies, these Fortune 500, Fortune 300, Fortune 250 companies, they'll be okay. You know, they make enough money in the markets, the 50, they invest their money into the market. So you got to also take that into what you're going to take those ones that are investing the money in the market and you're going to kind of exclude those guys because they're going to be all right no matter what. But you got to understand when these companies are taking 8.9, $11.2 billion losses, it's not, I don't care how big the company is. Okay. They're going to fill that 8.9, $11.2 billion. And then they're going to stop writing that business to be financially in the green. Or whatever we want to call it. If we don't want to be in the red, they have to stop taking those major losses. I mean, you're talking about it. Let's put in perspective. A company has 15 of those homes, and 15 of those homes are $10 million a piece up on the hills, overlooking the ocean. Fantastic view. But if they're taking those losses, there's no way they can sustain those losses year to year. So that's why you're seeing these law of large numbers, like you keep referring to, start dwindling down to smaller numbers because they're pulling out of these states. These bigger companies, they're starting to pull out of states completely. They pulled out of California. I'm not mentioning the companies because I'm not giving them any airtime. But anyways, a lot of these large companies are starting to pull out of these states individually. So yes, absolutely, you're going to start to see these numbers dwindle. Law of large numbers becomes minimal numbers.
But on the same coin, other side is they're eliminating risk. So now they're only insuring in places with virtually no risk or very limited risk. So now in theory, the costs should actually go down for somebody in South Jordan.
Yeah, but just because they pull out of a state, does that mean that the prices for things to be able to rebuild or fix, is that getting cheaper?
Well, no, but there's no risk. So what do they need the premium for if the risk has come down?
Well, you're pulling out of the major areas. There's still risk, but you're deducting, let's say, 10 to 15% out of a whole of the insurance companies. You're deducting 10 to 15%. Now, if we keep making these redundant roof claims like hail damage claims or whatever, you're going to keep seeing those minimal ones build up. And what people do is once they hear somebody, it catches fire. I got my roof replaced because of hail damage. Well, a roof every single time is $20,000. We're never going to recoup that out of a customer. Okay. So let's say the average roof is $21,000. Well, let's say everybody in the neighborhood got that redone because the roofer planted a sign in the neighborhood and he's knocking on every door and he's saying, hey, I got Julie's roof replaced for $21,000. Those are the other things. We're only looking at one small piece of the puzzle. Yes, the big fires, wildfires, but we're looking at the day-to-day stuff that doesn't happen or that happens every day rather than just the wildfires. Because right now we're focusing on the major issue of the wildfires, the floods, things like that. But that's not all there is. That's a piece of the puzzle, but that's not the whole piece of the puzzle. So you're trying to, companies are raising their rates right now. And I feel like they're just taking a stab at, hey, we're going to raise it 10%. We're going to raise it 25%. We're going to raise it 30%. And they're trying to get into that green again. So because every company obviously has their number loss, like you don't want to be 101 cents or whatever, because you're paying for every dollar, you're paying, a cent for that dollar. So you don't want to be in that ratio. So they want to be in the 95% ratio, the 98% ratio, where they're gaining a little bit, but they're not losing at all on any of these homes. So that's where most companies come to, is that how many homes do we have to sign versus how many losses are there? So, but again, your point is super valid. Like pulling out of these, you think, oh, okay, it's going to lower my price. It's not. So, and that's just how insurance companies are. Everybody hates insurance companies.
This is why. This is not true. They're good guys.
So, he's a good guy. The insurance companies,
we definitely need them. But like to your points, a new purchase of a new home. Say someone wants to finance a home and it's in Park City, it's in Immigration Canyon, it's in the foothills, anywhere. They have to get insurance.
Absolutely.
Right? So if they are financing the loan and their affordability, they're like right on the edge, whether or not they can qualify for their insurance might push them over to not being able to qualify for this home.
Reaching the DTI limit.
Right?
Yep.
Right.
Which is going to potentially have a subsequent issue on prices. Because if people can't qualify for the houses,
right,
because the insurance is too expensive, well, then the house price has to come down.
Something's going to have to happen. So we're at kind of
the interest rates aren't.
This flux. Yeah, because we've got high interest rates, we've got high insurance rates, we've got high prices. I mean, granted, our wages have gone up and everything like that, but we're looking at something like, and I don't think people, when they're writing their contracts and they're doing their due diligence, are shopping their insurance rate during that time.
Yeah.
So And granted, you still have the finance and appraisal, and you would hopefully know by then what your insurance is going to be. But what I'm saying is, like, you got to start thinking about this ahead of time. So maybe when you qualify for your house, you should figure out who your insurance provider is, and also the costs for insurance in the places you're interested in looking.
Yeah.
I think
it's a valid point, Judy. What most people need to realize is that you have these fly-by-night insurance agencies that everything is, you can't pick up a phone and talk to an insurance agent. Broch can. He can pick up the phone and call me anytime and say, hey, dude, why is this price going up? Where is this price? Where is that price? You always want somebody you can talk to. The younger generation, I feel like they want to, pay for it in out of sight, out of mind kind of mentality. And when you have insurance, remember, it only takes one time to sink your ship. If you don't have enough insurance in place, or you don't have adequate insurance, or you don't have insurance where you should in certain areas, that one time could ruin everything in your life. It could take away your home. It could take away what your livelihood as far as your family and stuff. And when I'm referring to that, I'm talking about liability issues. I mean, like I said to you, we live in a sue-happy society nowadays. So it's mind-blowing when people say, oh, hey, I got this price from where? Well, what's the coverage? Have no idea what the coverage is. No idea what the coverage is for the home, but it's cheaper than yours. And that's the battle we're fighting nowadays, is that all people care about is the bottom line price. They care about it until the one disaster happens. And then they're like, I should have paid another $14 a month.
Right. So that was my thought. I'm like, is it worth it to buy the house you want, but not have it insured to the level you need and have something happen and you lose literally everything? Is it worth it?
For sure not.
And what's your largest asset usually, Broch?
Yeah.
Usually your
house.
Home.
Yeah. Almost everyone I know.
Your home. So if it were me and I'm protecting my family, I would want my largest asset protected correctly. So if that home burns down to the ground, I want enough money to rebuild that. And we'll get into that a little bit later too. I believe Judy's got that on the docket, as far as what you should insure your home for, whether it be RCV or ACV. And she'll get into that a little bit later. So, but RCV RCV replacement cost valuation, and ACV actual cash value.
Right.
So absolutely. So
sweet.
But
yeah,
it's a lot to think about. But like, that's why I wanted to have you here. Is like, so you and we want to help people get into the house that they want, right?
Yeah.
But at what cost?
Right.
Like, if they can't afford to insure it to the level that they need to be in that house, is it the right house for them? Because it could be devastating if something actually happens.
Well, and thankfully, from the loan standpoint, we won't even allow them to finance it unless the insurance covers the replacement of the house. So they are somewhat protected, but it's a lot.
Yeah, but you don't know how many people will call the very next week and say, hey, I'm canceling the insurance. I'm going with this one. Okay, what's their coverage? Absolutely. After the loan's closed, they can do anything they want.
Yeah.
So, and they'll call and cancel the policy because it's $1,400. Well, they got a bid for $1,200 or $1,200 for $200 less a year, and there'll be $300,000 less in coverage. And they'll be like, well, my guy said I don't have to cover it for that much. Well, your guy's just trying to get you in the door so he can jack your price up next year after the initial payment is taken. So, and that's the big thing, is you got to watch for introductory rates. Introductory rates kill deals. So introductory rates, what that means is they're going to suck you in with a low price and then raise your rates the next 6 months or year. We don't do that.
Don't insurance reps get paid more on their first year premium?
You get a new business premium, and then it becomes what's called residual income. So residual income, you get paid a certain percentage off of obviously what is renewing. So you make it's not more money.
But is the percentage higher?
You're getting
year
paid
one?
Full premium off of the bat. So if you have $6,000 in premium, you're getting paid within that $6,000. If someone can lower it to $3,000, but yes, so you get paid your highest amount off the very beginning when insurance agents do sign you. Yes, because you're almost getting double paid.
So an insurance. I mean, obviously you want the residual, but there's big value in an insurance rep getting a new policy.
But you also want an insurance agent that will fight and look out for you too.
Right.
So, and that's why you go with me, is because every year I'm going to review your policy and tell you, hey, you know what? I think we can cut here. I think we can, we need to add here. Hey, maybe we need to do this. But that's what you need out of your insurance agent. You can't have these insurance agents that you guys are getting and it's all automated. Everything's automated nowadays, and I hate automation. So, and maybe it is because I'm older, Judy. I have no idea, but I'm telling you right now, if I call a bank and I get 17 questions through an automated service, I am not happy. You know, so it's super annoying when you can pick up the phone and I'll answer immediately and I'll answer any question you have. I don't care if it's the day, the weekend, or whatnot. I have 9 employees that would love to answer any questions you guys have. So find somebody, one, you can trust, and two, that's going to fight for you year after year and try to get your premium as low and not just drive premium up. I care about the person, and I know that sounds stupid and everybody probably sits here and says, oh, I care about the person. I care about the person. I actually care about you. It makes me happy inside to know that I can lower your premium. That's what makes me happy. So.
I think I'm a mix. I care about the person, and I definitely want to be able to talk to people, but I do want a good app or a good website.
Yeah, true.
Or
right.
a good, I want the good technology, but I also, there's nothing that replaces knowing someone and having them know you and being able to talk frankly with a real person.
And I wasn't trying to completely dismiss automation, okay? Automation on an app. We have an app. We have all the services that you possibly need as far as the apps and stuff like that. But when you have the hard questions, that's when you want an agent where you don't have to answer 14 questions just to get to a representative that can't answer your question in the first place.
Well, I think it goes like in any industry, whether it's real estate, mortgage, insurance, or any industry, you want somebody who is an expert in what they're doing and that you can lean on for advice. You 100%. Certainly don't want everything automated by a computer.
Right. The value of a human is they've had an experience.
Right. And they've got human capacity
right.
to problem solve and
right. And if they haven't had the experience, they know someone who's had a similar experience and they've learned from the experiences, right? You can't generate that with ChatGPT, or I mean, they know things.
You almost can now.
yeah, but the actual experience and how that relates to a human, and like different people are going to respond differently to different experiences. And if you know that person, you have a fairly good idea of how they might react to a similar experience, and you can help them on a personal level. So that's why it's really good to be able to connect with people.
Yep. And then reviewing your policies, like I think you brought that up a little bit earlier. I don't know if we brought it up here or if it was off camera, but yeah, reviewing your policies with your agent is vital. It is very important. I don't know if you put your pool in. I don't know if you've built something in your backyard. I don't know if you have a trampoline. I don't know. But these are things where, are we going to talk about, do you want to jump into the umbrella section?
I think we're going to talk about that. But I think before we get there, I wanted to go more into like your replacement costs. And so maybe this comes to it or whatever, and your review, because like I said, my son just started driving a car. I recently got a new car. You know, we've done things to our property. We've made changes, but at the same time, it's like, I don't want to overpay for insurance. But if something happens, I definitely don't want to be without a home or a car.
Absolutely.
Right?
Yep.
You know, so I'd like to segue into talking about those replacement costs and, you know, your coverage, and how do you know that you're paying not more than you have to, but you're covered to where you need to be.
Basically, how do you optimize it?
How do you
don't pay too
optimize
much,
it?
but have enough coverage.
Yeah, have coverage in case, because you don't ever want to have to go through that, but people do.
Absolutely.
People go through stuff all the time. People lose everything all the time. You never know, like, whose house could catch on fire because of some electrical problem, or some kind of random accident could happen. I mean, I had a client just get ready to list their house, and someone had a medical emergency, drove down a busy street, up their neighborhood street, and into their driveway and through the side of their garage.
Oh my
literally
gosh.
2 days before listing photos.
Oh my gosh.
So you never know
Wow.
what could happen. And luckily they had a great policy, and everything was covered and everything was replaced, and you know, they ended up looking great
That's
eventually.
crazy.
But like, stuff happens, and had they not had the right coverage, they could have lost the opportunity to sell the house, but that they had to sell because they were relocating. You know what I mean? So how do you know what your costs are, what it's going to cost to replace your stuff, and if you are not paying too much, but covered at the right level?
Absolutely. So what you're going is for value for cost. So that's what we're looking at internally. So I'm going to put this out there, okay? The state of Utah has a minimal. Okay, so your minimum coverage for the state of Utah is what's 35, 65, 15. Okay. Most people are like, what are you talking about? 30, 65, 50. I heard those numbers, okay? Listen, 30,000 is per person in the other car. So this is liability limit. So 30,000 per person in the other car, 65 aggregate, meaning no matter how many people get hurt in the other car, you have $65,000 worth of coverage. And the last one is for physical damage. So your person that ran into the home or whatnot, well, hopefully they had more than $25,000 for physical damage. And that's where it comes in, and it costs these companies minimal amounts of money to put that from 25,000. I believe in my agency, it costs you $6 every 6 months to put it from 25,000 to 100 grand. That's the price difference. Nothing. That is nothing. $6. But you're seeing these companies, your bigger companies, they're putting 25,000 because if they have physical damage, they don't want to pay out the physical damage. They don't want to pay out the 100 grand that it's going to cost. They'll happily hand the check over for 25 grand and leave the 75 grand on the customer. So that's where you're kind of getting into it. But the rule of thumb for me, I will not sign anybody under 50,000, 100,000, 100,000. Remember those three numbers, physical damage, and then the first two are liability numbers. I will not sign anybody under that because it's doing them a disservice. I don't want to sign anybody under that, but that's giving them the best cost that I can give you for insurance. I don't think anybody should be insured under 100,000, 300,000, 100,000. I think that's the minimal limit that people should be able to carry, even though the state presets it for 30, 65, 15,000 for collision.
What are the repercussions if you're underinsured?
So the repercussions are you have to pay that out of pocket. So you're going to either settle out in a lawsuit one way or another. The insurance is going to get their money. The companies, I'll tell you this, what insurance companies do have, great lawyers. Okay, so they will come after you, and they will come after you for let's say you got into a $100,000 accident, you only have $25,000 in coverage. That's $75,000 you are left with. So you're going to have to figure out that whether you refinance your house or whether you do something to pay for that, they're going to get that $75,000 one way or another. Okay, whether it's settled in a lawsuit. But that's what I'm saying is if you can't talk to anybody and you're being like you guys didn't know what those numbers meant. Mm-hmm. So if you don't have an agent to explain those numbers to you to see how important that number is to you personally, that's the factor. So if you have that $25,000 in coverage and you had the jerk of an agent that wrote you that policy that gave you that $25,000 and he knew better and it only cost that company $6 or cost you $6 or more, $6 more to have $100,000, $75,000 more in coverage, I guarantee if they would have gave you the option, you would have picked the $6 more. Mm-hmm. And that's 6 months, not $6 or more a month. That's for every 6 months. That's $6. That's $1 a month.
Yeah.
Wow. Well,
that's crazy.
And I think that a lot of times when you're thinking about what you're spending out, dollars are dollars, and everybody cares about spending the dollar. But when you realize the repercussions, you want to spend the dollar. And I think that's a lot of times what we're not realizing when we're thinking about how am I going to cut my costs is what do cutting those costs actually cost you?
Yep. Absolutely.
I think we're not really.
Yeah, we just did a podcast on this with the Loans Elevated podcast, which was tunnel vision on just looking at one thing. I'm looking at my payment and nothing else matters. Just like this, I'm looking at the cost of the monthly payment. Nothing else matters until it does. And the until it does matters a lot more than a few bucks a month. So that is where professionals come in, and it's crazy. I mean, that is the one thing, though, I would say ChatGPT is good at, because it will identify those risks for people. Whereas before ChatGPT, people just went online and said, give me the cheapest quote, and they didn't read any of the fine print. So
ChatGPT for risk management.
Right. But
absolutely.
You got to know
Ask
the
the
right questions to ask.
Yeah,
because if you're not asking the right questions, you're going to get not the right answer.
But again, being able to pick up a phone and calling one person and saying, hey, having a 5-second conversation and saying, hey, these guys are trying to cover me at 25 grand. What does this mean? you know? And I get people that leave my agency and they'll call me and say, hey, they put 25,000. You guys have me at 100 grand. What does this mean? So they didn't even get explained their policy. It was just cheaper. So they just went with it.
Right.
Now I have a question, follow up, because she was asking about coverage, and you went into the car coverage because a car had hit her client's house.
Absolutely.
But her client's insurance company had to cover it. So obviously what I'm getting at is if you're the homeowner and they hit your house and you can't control what that driver had in coverage, so how do you ensure that you have the proper coverage on your home for these crazy freak accidents?
Well, your insurance should have what's called uninsured and underinsured. So if someone hit your house, you should have, you actually went through this incident. So the person that hit you in your Porsche, remember, they had the state minimums, which at the time were 25, 65, 15. So she only had $15,000 in collision. We're talking about hitting a $200,000 Porsche. So what's going to happen? Our insurance company is going to make you right. We're going to give you your money. We're going to cut you that check, and then we're going to subrogate it. Subrogation means that we're going after the other company. So we're going to sue the other company or the person because they didn't have enough insurance, because most likely that company's going to be like, man, $15,000 in. You guys can sue the person now. Okay, they're going to pay out the 15 grand, but we want to make sure that you're indemnified by saying, hey, you know what? We're going to put you back to where you were, and then we'll go after them. Don't worry about it. So it makes it more simplistic for the customer. So is that kind of answering your question?
Well, yeah, but how does that relate to homeowners
I
insurance?
think their homeowners insurance covered
It's two different claims, believe it or not. So if an auto hits a home and it's you running into your own home, you're going to have an auto claim and you're going to have a homeowner's claim. So you're going to have two different claims. So you're going to end up having to pay two deductibles on that.
Got it. Interesting.
So
that's crazy.
They paid their deductible.
Your clients.
Yeah.
And then, everything was covered.
Yeah.
Yep.
That's crazy.
Yeah, it's funny enough. Yeah, you create a hole in your house, we'll take care of it.
So
you blow through your garage, we got you.
I mean, yeah, it's just.
But accidents do happen.
It's
I
so
mean,
crazy.
and that's what it is. What it's there for.
I never would, like, when they explained to me what happened, I was just like, I can't even. Nobody could even make that up. Like driving down a busy street, up a neighborhood street, in someone's driveway, and then through the side.
You're
of
like,
garage.
did you want to list with somebody else? You could just tell me if like, you don't need to make up a story.
I was like, oh my gosh, yeah. Okay, so now you mentioned before. Okay, so people of high net worth, and even sometimes people who are like small business owners, other people like that. If they have something outside of their home or outside of their car, there's the umbrella policies, right?
Absolutely.
So who would benefit from an umbrella policy? What is it? And how does adding on more insurance coverage, more expense for paying insurance, benefit you in the long run?
Absolutely. So you mentioned it's only for high valued customers. It's absolutely not.
It's not for.
No, I think that people, listen, an umbrella costs you, it's $1 million in liability. Okay. And that's the minimum policy that we write, but it's $1 million in liability over your home and your autos. Again, I mentioned that we live in a litigious sue happy society where everybody wants to sue, and nowadays, instead of work for their money, they want to sue people for money. So that's how they make a living. That's how some people make a living nowadays.
Know, yeah.
So they'll just sue a company, a slip and fall, whatever it may be. They slipped in your yard. Hey, you got a $2 million home. This is fantastic. I'm pretending I fell over your rake and stabbed myself. Okay. So you see these claims all the time, but umbrellas just aren't for the wealthy. It's for the more assets you have. So if you have razors, if you have four-wheelers, if you have everything that you have has liability every time you go out on that thing, it has liability attached to it. Okay. If you're taking somebody for a ride in your razor, which is very prevalent here in the state of Utah, everybody goes for razor rides and things up in the mountains and stuff. Well, if you take your buddy, you invited him up to the cabin, you roll that razor, you better have enough liability insurance to pay for his damages. Okay. And I actually have a very personal friend that was degloved, and it cost hundreds and hundreds and hundreds of thousands worth of surgeries, and he's still having surgeries to this day. And that person didn't have that liability insurance. So they ended up being sued. Okay. And then when you're sued, they had to sell their house. They had to do everything just to pay this guy off. So that's the important part of the umbrellas. But I tell people, if you have kids, as soon as they turn 16, I would get an umbrella. Okay. Because again, kids are very expensive. 16-year-olds are very expensive to add to your policy. The reason being is because 81% of 16-year-olds, for the first 2 years of their driving history, 81% of them get in some form of accident. That's why they're so expensive. That's a high percentage. 81% of kids getting into accidents, that's crazy. I was in that percentage. When I was 17 years old, slammed into somebody, I was like, man. my
Kira, what about you?
Yeah.
Yep. Okay, we're 100%.
We're 100%, yeah. So, and my insurance payment was way more than my piece of crap car that I had. So I think I was paying $400 a month in insurance. And when I was a kid, 17, 18 years old, I'm like, man, I can't afford $400.
Yeah.
You know, so, but anyways, and that's what happens is if you run into the wrong person, you don't have to worry about, oh, I got to fix their car. You got to worry about them stepping out of the car and saying, oh, my neck hurts. You know,
well, I think there's a misconception which kind of spawned this question. I would imagine is that if you're a high net worth person, you need more insurance. You need an umbrella coverage to cover your things. That's actually not what it is. It's to cover the liability caused by whatever happens. And so, if you own a house with $500,000 in equity, which a lot of people do nowadays, well, you got to protect that. An umbrella policy is what would protect that.
Yep.
So it's almost like every person that has any form, every homeowner should probably have an umbrella policy.
Absolutely. So, and the people that ask me like, hey, should you have an umbrella? I'm biased. If you ask an insurance agent, he's always going to tell you you should get an umbrella because I see the stuff every single day. As an individual, as you guys watch after yourselves, you don't see it every day. I see these claims come through, these most ridiculous claims for liability that sink ships. And when I say sink ships, if you don't have the money, you're going to be sued. Okay. And they can take your home. They can take whatever they need to make sure that bill is paid.
Can't they take your 401k? I think they can.
I'm not sure.
I think that's protected.
That's protected?
Yeah.
I think that's protected.
There's a libel act or something like that I think protects that. But they can
when
come
you
after every other
retire-
asset that
Right.
you have.
Yeah, for sure. For sure.
They can come after every other asset that you have, though.
Wow.
So, and that's the scary thing. And I'm not telling you to go out there, run out there and get a umbrella. A lot of these new home buyers and stuff that Broch deals with and stuff, they're just figuring out how much they can afford for their house payment and stuff like that. So an umbrella, if you got one car you're sharing in between you and your wife and you don't have kids and stuff like that, I don't know if an umbrella is the right step for you. Okay. But if you have kids that are driving, if you have a house that has a swimming pool, if you have a house that has if you have a dog, even, like nowadays dog bites, they're expensive. So,
or you just have assets you need to protect. If you have a lot of equity.
Absolutely.
Yeah.
The more things you have, the more likelihood it should be that you should have an umbrella.
Yeah.
And like I said, the cost of an umbrella, $300 a year for $1 million more in liability protection over your home and your auto or whatever you own, trailers, UTVs, whatever it is. The liability is up by $1 million every single time.
So for $25 a month, you protect yourself against those crazy people. Like I'm sure we've all seen on Instagram or TikTok, those videos where people have dash cams and you'll see people stop at a red light, put it in reverse and floor it backwards and hit them. And they are those people just trying to find a lawsuit to take advantage of somebody. And it's like, you never know if you could get caught in some crazy thing like that.
Absolutely. And that's a reason I think dash cams are becoming so much more popular nowadays is because people want to record these incidences. Yeah. And that's how we're finding them on your YouTubes and things like that is because people are getting dash cams when they should be getting, hey, get a liability policy. It's cheaper than a dash cam.
Some of these cars like the Tesla or Rivian automatically record this stuff.
It, yep. Absolutely. My son was in an accident and the girl T-boned it and there was a Tesla behind him and it recorded the whole thing.
Yeah.
So
cool.
That
pretty
is
crazy.
awesome.
Yeah.
That is really awesome. Yeah, I think my car has a recording thing in it now too. So.
Yeah, absolutely.
It'll just make insurance more expensive because now you got to replace the cameras. So we're damned
Not
if we do, damned if we don't.
Dash cam. So absolutely.
Okay, so we were talking about the policies and a 5-year review. And like you mentioned, if you've lived in your house for 5 years already, you have a ton of equity just from the last 5 years. If you've lived in your house for 10 years, you have probably $200,000 or $300,000 easy in equity.
Minimum.
Easy.
Yeah.
So if you've lived in your house for longer than 5 years, you probably should have an umbrella policy.
Yes, just because of the equity aspect of it. So, I mean, who wants to give away their equity? And that's essentially what you're doing if you don't have enough coverage and someone sues you. If they sue you for $500,000, where are you going to pull that out of? Right out of your home, right out of your equity.
They'll tell you to pull it out of your home.
So and it sucks because you have to settle at some point.
100%.
And if you had that insurance policy, the insurance company is going to hire their lawyer to fight it for you. You're not going to have to pay your own lawyer.
Absolutely.
Because that stuff never ends. I mean,
but you have to have that policy in place.
Right, exactly. Right.
You have to have that. So like Broch said, he hit the nail right on the head when he said $25 a month. What is that? That's maybe 2 coffees, a week or so.
Right. Maybe it's half a lunch.
Yeah.
Right. Half a lunch nowadays. Yeah. So, yeah, but absolutely, yeah. I think everybody should have an umbrella, but essentially what it comes down, the more assets you have, the more likelihood you should have an umbrella.
Right. Okay, so now I think we were talking earlier about people who are looking to buy their next home, right, and shopping for insurance. When do you usually meet someone who's looking to buy a home?
I meet him right after Broch talks to him.
Yeah, we definitely try to get our clients to insurance ASAP.
Okay.
Because to your point, some of that due diligence isn't taken up front, and we recognize, because we're pros at what we do, just like you are and he is, we recognize that there could be a significant impact on what you're willing to spend, how much it costs. So we recommend they do it right away at pre-approval. Start shopping.
Right, and do you have the conversations with them about their whole, so they might be coming to you because they're going to buy a house, but they already have a business or a car or whatever. You have those conversations with them.
Cover everything that they own, and I make sure I ask those questions, and that's being a good servant to your customer. So you want to ask those questions, those probing questions. Hey, do you own a business? What else can I insure for you? So there are some companies that cap their discounts. We don't cap discounts, which is huge in our industry. Okay. And again, we're only in 19 states. So being in those 19 states, we're not in bordering states. We're not in coastal states. We're not in the tornado alley states. We stay out of those states just because, again, our reinsurance companies are there. So obviously those are going to affect us a little bit, but it's not going to affect us as much as the main company being in that state. Okay, so that's why we're able to keep our prices so low. And the reason Broch uses me, I mean, he loves me to death. I know he does. But he uses me because I am a fair price for your customer, if not the cheapest in the state of Utah. So when I usually compete against somebody for the homeowner's insurance, one of the reasons I bring value is because I can get that price down, especially for new home buyers. They're trying to keep that price as low as they can. And I'm just one of the tools that he uses in order to do that.
Yeah, and I always encourage clients, shop every policy you have, because you're shorting yourself if you don't. Having the policies split is silly.
Right.
Well, bundling stuff usually saves you somewhere upwards of about 27%, which your insurance agent should be offering the bundle deals. Now, some of your bigger companies, they're only offering like the bigger auto insurance companies. They're only offering a 4 to 5% discount. And the reason they do that is because they actually don't use their own insurance company for the homeowner's insurance. They use a sister company.
Well, they broker it out,
and they kind of broker it out and use a different company to write the homeowners, and then they write personally the auto insurance. So you got to watch out for that, because if you're not getting the value, why not go bundle with somebody that's going to save you 28% if you bundle your auto and your home together? So that's what you want to do, is also look for those maximized discounts. Again, talk to an agent and he can point that out for you. Okay. Rather than going online and doing a quote. So, which is 99% of the time not the quote that you're going to get.
Right. It's interesting when you actually see everything come back and you're like, wait a minute, that's not
right. Yeah.
I swear it was cheaper than that. Did I get a screenshot?
I emailed myself this quote. It's not matching up. So
again, on the properties that are going to be harder to insure. So if someone wants to buy a new property and it's in Immigration Canyon, say, and we're shopping for insurance. Well, they come up it's too high of a fire risk. What do we do then?
So I'm kind of a double-edged sword. So I actually can broker things out too. So I can go to brokerages that will write these homes and stuff. So I always have an option. It just might not be the cheapest option. But again, there's no other option. That's why I said it kind of creates a monopoly in the system. So
Right.
I'm kind of a double-edged sword. A lot of captured agencies, which you call captured agencies when they're American Family Insurance or any of the bigger conglomerates, you call it a captured agency. Brokerages are ones that can write 30, 40 different companies. Well, we can also do that, okay? We work with a brokerage as well, so that's why I say we're kind of a double-edged sword. If I can't get you the cheapest price through American Family Insurance, I'm going to find the next best option for you.
Okay, awesome. Now, my next question is, say that, okay, in order to buy this house, we have to have this insurance policy, and it costs us X dollars amount per year, which when you add that up is a big chunk of money. And say your client barely qualifies for the loan, would you think that going back and renegotiating a better price for the property because there's no option for insurance
Or a
would be
rate buy down.
or something like that?
Because financing is so cheap.
Yeah.
Cost per thousand is like less than $7 a month.
So to keep the price for the new purchaser the same, you would say, let's renegotiate a concession to buy down their rates so that their payments balancing out more.
Yeah, exactly. Because if you on like a $700,000 house, you drop the rate 1/8%, you're going to save, I don't know, somewhere around $30 a month, $35 a month for every eighth. And that eighth is only going to cost you, on a $700,000 house, it's going to cost you like $1,800, something like that. Versus if you drop the price $1,800,
Got it.
it's going to save you like $15 a month, not even, $12 a month. So it's a much better ratio by buying the rate down.
That makes sense. It's just something to think about because in my head, I see insurance costs going up, prices of houses are going up, and some of these houses are in areas where it's going to be, the insurance prices are going to be affected by where they're located at, and people purchasing them probably need to think about that ahead of time. But I'm just thinking, I'm like, so where do you negotiate that cost? So now I know.
I think the rates are probably the easiest. That's what I would say.
And the smartest too, because it's it will balance their payments out.
Right. Yeah, it's going to save them the most money for the least. And it's like, are you really going to be able to negotiate 50 or 100,000 off the price? No. The seller's just not going to sell the house.
Right.
So it's
right. But the buyer wants to buy it, the seller wants to sell it. How do you make it right for everybody?
Yep,
right.
Yep,
yeah.
Yep.
That's awesome. Okay. Well,
we tell Alan to stop getting greedy.
He's not.
I'm teasing. I'm teasing.
That's the MO for insurance agents. We're all greedy.
Now, I'm just saying what everyone that's watching this is thinking.
I'll be honest. Like when we were there, the kid has to drive a car, and we want him to drive the car because we want to have that time freed up for us. Instead of like taking them to school and picking them up, that was like literally an hour of my day every day for the last so long. So when we were able to get him driving the car, it was like a big deal for us. But at the same time, we're like, okay, wait a minute. It costs how much for him to drive a car?
You're like, crap. Well, we better invest these hours.
And it goes into that 81 percentile of them all getting into accidents within the first 2 years. That's why they're so high or the price is so high. No matter what company you're with, it's going to be a wow moment.
Right.
So,
but with that in mind, I thought in the event that something happens, it doesn't make sense to not be covered as much as you needed just to save a few dollars, because it just didn't. So that's why I wanted to have the conversation, and because I'm sure I'm not the only one that's in that thought process or situation. And I don't think it's the insurance companies. I just think it's the situation. But how do you make sure that you're covered the way you need to be and still at the best price?
In adding a 16-year-old. So, and a lot of people, what they don't understand is when you add a 16-year-old, you're adding them to the household, okay? We're not looking at it as, hey, we're putting a 16 on a 1988 Honda Accord. That 16 is displaced amongst all four vehicles.
On the brand new BMW.
Yep.
He's not going to drive.
Yeah, so he's not going to drive the BMW. He's not going to drive the Mercedes. He's not going to drive the $100,000 F-350 or whatever you may have. But that doesn't matter. If he's within the household, that means he has access to those keys. Okay. So whether he asks your permission or not, he might sneak out one night and, take the BMW or whatnot. And that's where insurance has come from. But you can do things to mitigate the pricing as far as adding teenagers. There's always Young Volunteer. So Young Volunteer is something we have that gives about a 7% discount, which is pretty big when you're talking about how much they cost you. 7% of what they cost you is pretty huge when it comes down to a 16-year-old. Okay. And then there's also something that's called good student discount. So those are two things they can do. And they can also take driving courses that some of these insurance companies offers, including mine, that give them up to a 10% discount. They can do a My Drive. So we try to do everything that we can add. But I always tell people the cheapest way to add a 16-year-old is make sure you buy him a vehicle. Don't go out there and buy him a $100,000 vehicle. I don't care how much money you have. That's just the stupidest thing I've ever heard. I mean, don't go out there and buy him a BMW, a Lamborghini, or buy a car that you can put on liability only. Okay. And what liability only means is if you get into an accident, all you're doing is walking away from the car. Okay. We're still covering the liability aspect of it for the other people in the other vehicle and everything. The only thing you're doing is walking away from the car. But that is probably the biggest way to mitigate that price is to put a car that you can, or add a car that you can put at liability only. So, and I've actually tried to talk people into, and I'm not putting a plug in for it, but refurbished vehicles. You can get a real nice refurbished vehicle for a lot, $5,000 off of what it would cost you normally. So I always tell people, get something refurbished, something that costs you minimal that you can put on that liability only, and then they are assigned to that car. Now, the car that they are assigned to is a big thing because that's the car that they're going to be responsible for, and that's the one that they're going to go the highest on the price on. So, and then it's displaced evenly throughout the other cars. So that's kind of the ways I have to save you money. But again, it takes talking to a person, not just filling out an app online and then submitting that app and just say, okay, that's the price.
Yeah, you're never going to get that creative strategy.
Yeah.
No.
And so what you're saying is buy a car that you're willing to you just assume as soon as you write the check for the car, the money's gone. You're not going to recoup it by selling it. Just that's the type of car you recommend buying.
I refer it to people having a threshold. Have a threshold of what you feel comfortable of losing. So my threshold in my household for a liability only car would be 10 grand. Anything under 10 grand, I'm okay walking away from it because I have enough financial stability where I could walk away from that 10 grand and I would be just fine. Okay. Anything above that, I wouldn't be comfortable with, but some people's thresholds might be 2 grand, might be 5 grand. I don't know what your threshold or what you're comfortable with losing. But that's how you have to look at it. When you buy that vehicle, you got to be okay. I know I'm never going to see this money again if I walk away from this vehicle, and I'm okay with that.
Right. It's a depreciating asset.
Absolutely. If you drive it off the lot, you lose
and you're
it.
like, done.
Gone, right? Yeah, for sure.
Unless you buy Porsches and then
depending on the situation,
Yeah, sometimes those are appreciating assets. Okay, so big question. What should homeowners do this month to make sure that, one, they have enough coverage, and two, they are paying the right price?
One, call me. You should call me right now. So as soon as you get done watching this, call me. So honestly, you should be having a annual review. When I say that yearly, you should be reviewing because you're always evolving. I don't care whether it's down, up, sideways, you're always evolving. Okay. So as you're evolving, you should be going over with your agent. You know what? I got this. I forgot to tell you, I put this in and that and that. You should have a review with your agent every single year, or a staff member that is very informed. You should be having a review with whatever agency you are once a year at least.
Like a health checkup for your
Yeah, you go to the doctor once a year. You want to know you're cancer free, or you get your mammograms, or whatever it may be. You want to make sure that you're checking up on your insurance the same way. So, and then that way you can discuss what you should have as adequate coverage. But the thing is that this should be presented to you in a way where you understand it the first time you sign with the insurance agency. So you should have an agent that has explained at least 6 major details within your homeowner's policy in order to get the accurate and efficient quote that you need.
I think that there is a happening where people are so used to massive amounts of information and intentionally not trying to understand everything. They're just like, okay, big picture, I'm paying this much for my homeowner's insurance. I'm going to walk away now. This is the least amount I can pay for my homeowner's
Ignore
insurance.
the noise.
Yeah, they don't want to go into the depths of understanding it because one, it's a lot of information, and two, maybe they feel like if I have to read all of this, like if you're online or whatever, there's like pages and pages and pages of small print. Who's going to process all that?
Whoever clicks the link to read the terms and conditions on every website you click, yes, I agree to them. No one.
Nobody
ever.
does this. Nobody
You're
does
agreeing
this.
to all sorts
so
of stuff.
I think it's becoming normalized to not know what you're getting and what you're paying for and the processes and all of this other stuff. Like I run into it a lot with people who are purchasing a house. And I'm like, well, these are all of the steps. And this is what they're like, well, I just don't, sign the paperwork and I move into the house. When we close on the paperwork, I don't get the keys. I'm like, no, there's like all of these details and steps that go with it.
And again, that's where the expert comes in. And that's the crazy thing about, and I don't know what's going to happen, but like he said, the automation, there's a certain set of people that feel like they can go at it alone. But what they're missing is there are all of these nuanced micro details that you wouldn't even think about if you go at it alone. So you might save $5 here, but you lost $25,000 because you didn't know this.
It. You didn't even know it, and you're okay not knowing it.
Right. Yeah.
Because you're used to not knowing it.
For sure. Yeah.
And you think that everything's going to work out.
Ignorance is not always bliss.
It's not. Yeah. That's what I was thinking. Like when we went through all of this and we're like, okay, so how do we mitigate costs but still be covered and everything like that? And it's like, if you don't really ask the questions, you don't know.
Mm-hmm. And that's the thing is that you have to have an agent that you can talk to. So every time I sign one of Broch's clients or somebody new that is just buying a home for the first time, that's why I mentioned the 6 key points. Like it's not too hard to explain 6 key points. You can usually do it within 2 minutes. And then people are all, okay, that's that coverage, that's that coverage, that's coverage. If I explained your whole policy to you, you'd be like, bleh. Like, when are you going to stop talking to me? So, but I've broken it down into 6 key points that you need to know about your insurance. And most everybody, after I do it, develop a Q&A with me. So, and if you're finding your customers and stuff, and you should be having a Q&A with whoever you're doing business with. Okay, if you're just saying, yeah, that sounds good. Yeah, that sounds good. Well, you're the easiest person to take advantage, and you're our favorite customer because I just charged you an extra $25,000 you didn't even know about. So, but that's what I want is I want to develop a Q&A, and I want to make sure that you hit 6 quick topics, and that's all I care about, that you know about your policy. At least you know a little about your policy, and I feel better about you knowing about that little piece. And the 6 keys that I point out to you are pretty easy to remember. It's not puking that information onto you that people just don't give a crap about. So again, talking to somebody. The reason why
they're okay not knowing it.
Yes. Yes.
But that's, yeah. All right.
But make it simplified. So, and then a lot of people, they refuse to do that, but I simplify things for people. I want to make it as simple as most of the understanding as possible. And those 6 key steps are the way to do that.
So right now, this month, they should call you and go over the 6 key steps.
Yes. 6 key steps.
At least to make sure that they are covered.
The 6 key insurance places that you want to look on your insurance and make sure you're covered correctly or at least adequately.
But the beauty is if they call you, it's a free consultation. You shop it out.
100%.
They may or may not save money. They can have a choice, but at least they get the information.
Yeah, at least you know where you're at. So like rather than looking at it blindly, at least you know where you stand. If you have a good rate, that's fantastic. If you need somebody to call to ask questions because your automated service doesn't do it, I'm more than happy to answer that phone call. I have people that don't go with me all the time, and they call and ask me questions about their insurance policies all the time. And I'm like, man, you know you didn't go with me, right? Yeah, but I can't get a hold of my agent.
We all have those friends. It's funny.
And I love to be that guy because one day I'll have you. So absolutely.
Yeah.
Yep.
Well, and if you want Alan's 6 things to do to know about your insurance.
Yes. The 6 items of action that you need to know about your insurance that you shouldn't be blind about, please call me.
And email me, and I will get you connected with him.